This video clip explains how short selling is being abused by large Wall Street players and its impact on American capitalism and the jobless crisis. Most of you already know what short selling is, but bear with me while I explain the basics for those who may not. Short selling employs upside-down logic regarding property ownership. It only exists on Wall Street. It's the ability to sell something that you don't own and immediately pocket the proceeds. Stock markets work on the principle of an opening and closing position on a particular stock. You can buy it or sell it. Wall Street doesn't care, as long as you eventually pair that opening transaction with the opposite transaction, closing the position you originally took. When I was taking courses for the Series 7 exam, it was a concept that many in the class had a hard time getting their heads around. Show me any other market where I can sell someone else's property, a car or camera, and not get arrested. Think of it as a broker simply loaning you someone else's stock that he was holding on to, with the expectation that you will eventually return like stock to replace what you sold. Here's a quick run-through of how it works in practice. If I'm optimistic about a company's prospects, my opening position will be long. I invest, buying 1,000 shares at $10 a share. I must deliver $10,000 to the broker. If I'm pessimistic about the company's prospects and want to speculate on a fall in the stock price, my opening position will be short. I sell 1,000 shares that the broker lends me. $10,000 in proceeds go into my account, cash in the bank. Here are some of the possible outcomes for this simple example. If the price goes up $2, the optimist who was long, the investor, makes a $2,000 profit, and the pessimist who was short, the speculator, has a $2,000 loss. If the stock price goes down $2, the results are reversed. The investor loses $2,000 and the speculator gains $2,000. Pretty simple, and on a retail level, with the average investor placing trades, short selling, although purely speculative in nature, is fairly benign. However, short selling at an institutional level by big Wall Street players is anything but benign. It's predatory, and the outcome of every transaction is a certainty. There is no risk involved. It's not even speculating, it's harvesting. Let me explain how it works. It starts by identifying a target. Here's a typical target profile. A small to mid-sized listed company. Initial capitalization around 30 million. 4.3 million shares floated at $7 per share, with 20 million shares outstanding. Currently trading between $8 to $12 per share. At those prices, market cap between 160 and 240 million. This is a Main Street company, the backbone of American capitalism, operating around break-even because profits are being plowed back into growth. Solid customer base with more in the pipeline. Providing jobs, healthcare, and old age security to upwards of 300 dedicated employees. Looking for growth capital, term sheets in play, but they've put off funding waiting for a better multiple. Going back to our previous slide, once the target is identified, the first large short position is placed, often by an offshore fund operating out of somewhere like the Cayman Islands. Good luck tracing that entity back to the Wall Street player that actually owns it. When I worked at Citibank, many of the private banking and investment operations were carried out behind a veil of more than 6,000 corporate entities in over 200 countries. Keeping the example simple, it starts with someone taking a large short position, say 300,000 shares at $12 per share. The seller immediately pockets $3.6 million in proceeds. He doesn't have to lay out a single penny. The effect is immediate. Investor confidence is shaken by the transaction, and support for the stock begins to fade. A short position this large is a major chunk of the daily trade volume for a company this size. Everyone is now nervous. That guy must know something that the company isn't telling us, is what everyone is thinking. Some investors start selling off their holdings, and the stock price begins its precipitous slide. The company takes countermeasures to reassure investors and stop the price slide, but it's already too late. They just don't know it. Here's a typical timeline progression. They accelerate the announcement of a major new customer agreement. Bam! Another speculator sells short 200,000 shares at $10 per share and pockets $2 million, neutralizing news that should have caused the price to spike upwards. The company then announces early release of their next generation of product, sure to be a category killer. Wham! Another short sale of 300,000 shares, the price now at $8, proceeds of $2.4 million. The other investors are now in a panic. The board announces a shakeup and hires a new high-profile CEO to bolster investor confidence. Bam! Another short sell for 300,000 shares, the price now at $6, netting $1.8 million, neutralizing that news. At this point, there's nothing the company can do but ride the price slide to the bottom and hope they survive. The price quickly falls below $5 a share, and all kinds of bad things start to happen. All the second-round investors who were courting you back away. The stock gets delisted. Long-term viability becomes an issue for key customers, and they begin moving their business elsewhere. The company's prior growth trajectory stalls and goes into an agonizing death spiral, chasing performance numbers downward. The pipeline dries up, long-term viability being the key concern of potential customers. Current and projected revenues plummet. Severe cost-cutting impairs the company's ability to deliver. Layoffs result in the loss of core disciplines. Even if the company remains in business, the stock is now trading for pennies. The goal of these institutional short sellers has been achieved. They cover their short positions and walk away with huge fortunes, everyone else the losers for their gains. So many good, solid American companies have been pulled through this Wall Street slaughterhouse over the past few decades. The practice needs to stop. This story, and many like it, are being played out every day on Wall Street, and as sad as it may seem for a company to go under this way, the impact on our society is far wider than you may imagine. It's not just the loss of jobs and health care for these 300 affected families. It's all that company's vendors that lost a good customer and probably got stuck with hundreds of thousands of dollars in receivables they couldn't collect when the company went under, or pennies on the dollar if they stayed in business. It even reduces the local tax base. This type of profiteering affects everything in our economy in a negative way. It's not healthy capitalism, it's unhealthy greed. Here's the rationale for regulating this activity. Short selling, as most of us understand it at the retail level, has a lot of upside risk. You can get killed if the price goes up. Short selling would be okay if you believe the myth that company performance is the only determinant of stock price. Wall Street's institutional players, often through their offshore avatars, have turned short selling into a very lucrative industry. For these big players, there's no risk involved. Once the process starts, price decline is a 100% certainty. This is a predatory practice. Once a company is culled from the herd, the company has no further control over its destiny. Institutional short sellers are the jackals of Wall Street, and they have the power to drive a company's stock price to zero. Short selling is a bizarre form of betting. When was the last time you were at a racetrack and bet on a horse to lose? The guys at the window would think you're nuts. You only bet on your favorites to win. To do otherwise would be unsportsmanlike. Short selling is a bet against our economy. It's a bet against the American dream. If individual speculators want to continue the practice, it stinks, but sure, go ahead. At a retail level, they're nothing more than flies that feed on Wall Street's rot and scatter when any good news is released from the company they've been shorting. However, institutional short selling by big players is another matter. These are jackals that hunt in packs and have the ability to regularly bring down healthy companies. Their activities, if not prohibited completely, should be sharply curtailed with daily trade caps and total transparency as to who really is doing the short selling and how it all ties back to big Wall Street players. That concludes this presentation. I would welcome your comments either here or on our blog at www.rootcausemovement.com. Thanks for your engagement.